Hello, everyone. Welcome, welcome. Welcome. You are in the right spot. We're just going to wait just a couple of seconds for everyone to filter on in, but welcome to the webinar. Awesome. As everyone's joining us, welcome. You're in the right spot. We're just giving everyone a couple seconds to hop in. All right. Well, while we're waiting for everyone to join, I'll just go ahead and get started with our housekeeping items. Hello, everyone, and welcome to the M&A Outlook for Business Owners and Sellers in 2025, Opportunities under a New Presidency. We're glad to have you with us today. Before I introduce our speakers, a few housekeeping items. This webinar is being recorded, so be on the lookout today for an email containing a link to the recording, as well as the slides and other helpful content. This webinar will run for 50 minutes, 50, with a 10-minute Q&A immediately following. If you have any questions for our speakers, please put them in the Q&A box located in the Zoom toolbar. To find the Zoom toolbar, hover your mouse over the top or bottom of your screen and the toolbar will pop up. All right, now I'd like to introduce to you our speakers. Jeff Box is a partner in LSL's Tax and Advisory Department. His clients, which include privately held businesses ranging from manufacturers and distributors, professional service providers, and high net worth individuals, rely on his advice and assistance on a broad range of financial issues beyond tax compliance. He routinely provides solutions including business and multi-generational tax forecasting and planning, merger and acquisition guidance, and retirement planning. Dora Lanza is the co-founder of Plethora Businesses. Since 1985, she has been working with business owners as well as institutional and private investors. As the operations manager for Plethora Businesses, Dora works with business owners and deal makers in assessing the value of privately held companies, structuring and financing the complexity of business transactions. She has been awarded the highly coveted designations of Merger and Acquisition Master Intermediary by the highly coveted by the M&A Source and Certified Businesses Intermediary by the International Business Brokers Association. Christopher Aragon is an associate at Plethora and is responsible for analyzing financial statements, building operational models, as well as assisting with industry and market research. He is a graduate from Cal State University Fullerton with a BA in Business Analytics. He is licensed with the DRE and is currently in pursuit of FINRA Series 63 and 79 licenses. Jenny Tran is an experienced business and tax planning lawyer at the law firm of Stradling, Yoka, Carlson, and Ralph. Her areas of practice include business sale and tax planning for privately held businesses and their owners on entity design, business succession, risk management and allocation, corporate compliance and governance, and operations, mergers and acquisitions. She serves as outside general counsel to privately held businesses in a variety of industries, including aerospace, energy, online, digital media, and communities, insurance agencies, retail markets, pharmacies, hotel franchisees, fashion, and food and beverage operators. All right, now I'll hand it over to our speakers.
All right, thank you, Cami. So let's have a quick recap of what we've seen so far this year. A key point of emphasis for the chart you're seeing on the right is that the data shown is only through the first 3 quarters of this year, which is why it's still showing a downward trend. Quarter 4 of 2024 is expected to greatly boost the overall numbers, but we'll go into more detail shortly. This year started out optimistically and thankfully maintained its performance even through a presidential election cycle. One major boon for M&A in 2024 was the first rate cut the Fed instituted. This helped alleviate the pressure on financial buyers, such as private equity groups, and we saw a near immediate uptick in deal demand from such groups. While the rate cut was beneficial, Some groups continued to sit on the sideline until the new administration was decided. Looking ahead to next year, there are rumblings that there could be as much as 3 rate cuts next year, which would have a positive effect on deal activity. Also, with the new administration having control of all 3 branches of government, the market is cautiously optimistic heading into the new year. How well it goes will depend on inflation, interest rates, and the policies of the new administration. Now let's move to a more detailed look at deal flow for this year. So here's a more detailed breakdown of the chart on the previous slide. The dark blue bars represent deal value, while that light blue line shows us deal volume. And those yellow dots are the optimistic projections from the beginning of the year. As mentioned in the previous slide, many groups were cautious this year as people were waiting to see how the Fed responded to inflation, along with the results of the election. Overall, deal values are up versus last year, with deal volume showing a downward trend as we approached the election. To give you a little bit more of a clear picture, so far this year, M&A activity is ahead 27.6% in deal value and around 13% by volume versus the same period last year. With the election over, we are looking at another spike in deals completed, much like you see in Q4 of 2023, as groups are looking to close out their deals before the end of the year. Up next, we'll look at how different business sectors performed so far this year. So this is a breakdown of M&A activity by industry. As you can see, the heavy hitters in 2023 remain dominant in 2024. Out of all deals completed in 2024, business to business or B2B represented the highest percentage of deals completed so far. Some of the performance of B2B deals in M&A this year are due to some mega deals, including the purchase of DB Schenker by DSB. Plethora personally has especially seen an increase this year in buyers looking for cross-border solutions as businesses continue their nearshoring plans. The other giant in the room is the IT technology sector. While it only captured 17% of deal volume so far this year, it's responsible for 23% of the total deal value. Within the IT tech sector, recurring revenue is a vital metric that buyers are looking for in a new acquisition. Software as a service, or SaaS, continues to be seen as king. That being said, while certain industries may not be in trend, there are compensating factors that may drive buyer interest in the next year. I'm now going to pass it over to Dora, who will go over some buyer trends for this year.
Thank you, Chris. I think that what's interesting is looking at the statistics that the deal by private equity only represented 33% of the acquisitions. So that lets you know that strategic acquirers are the ones that are most actively investing. And so there are a couple of reasons for that. Private equity firms are required to return profits to their investors. And so they hold off looking for quality assets. Across the board, they invest in all deal sizes, but the younger private equity firms, those that are on their first round of funding, are more flexible on their minimums. So established private equity firms are looking for minimum EBITDAs of 2 to 3 million on north of that, whereas a younger private equity firm may contemplate EBITDAs of 1 million or more. Some private equities will spin off a sister division for Main Street. So we've seen also a lot of deals being put on the market by private equity. And most of the deals completed by PE platforms have been as they make multiple add-on acquisitions. So here, the idea is to grow their portfolio companies and get them ready for the next sale. And they do that by looking at new products, new markets. So anything that's complementary to a platform makes a good acquisition for them in the form of an add-on. The other thing that's interesting, if we look at the next slide, private equity firms are competing fiercely for these quality assets, specifically in healthcare, software as a service, and green energy sectors. 2025 is projecting a deal volume to grow by 18% according to McKinsey M&A Trends in a recently published article. And what's driving part of that growth is renewable energy, healthcare, and technology. Something else that is top of mind for a lot of private equity groups when they're making their acquisition criterias is a focus on ESG, environmental social governance. So they want to make sure that the companies that they're acquiring are on a path to delivering ESG as well. If we move on to Chris, he will share with you interest rates and annual deal volume.
Thank you, Dora. So since interest rates play such an important role in M&A, we thought it would be important to provide a little color. The graph on the right shows us the average federal funds rate as well as the volume of M&A activity for the past 8 years in North America. As you may know, these rates have a significant impact on the overall economy, which in turn causes waves in the M&A market. 2021 was the peak of M&A activity due to incredibly low interest rates and why deal flow has been suppressed over these past 2 years with higher rates. Any additional rate cuts or even rates holding level next year will help bolster M&A activity in 2025. Higher interest rates typically make leverage buyouts more expensive and puts pressure on both deal volume and deal values. Due to their inverse relationship, as rates decline, we will look to see both deal volume and deal valuation increase. How much of an effect it has on valuation multiple often comes down to who has more leverage in deal negotiation. As such, we believe both strategic and private equity groups will look to be aggressive next year in what looks to be a bullish market. Next up, we're going to cover some future risks to be on the lookout for when preparing to sell your business. So the elephant in the room are the threats of new tariffs from the Trump administration. A trade war would put significant pressure on US businesses. As such, buyers will be extra sensitive to potential supply chain issues stemming from the new administration's stated goals. So expect extra scrutiny around this topic with any buyers next year or in the next coming years, especially during diligence. Another area of focus should be trying to lower your receivable collections period as low as possible. So look for those outlier clients and strategize on how to get them to pay sooner. We're going to continue to hear about large-scale hacks affecting large portions of the country. The most recent news was that phone and text messages are easily readable, which may threaten two-factor authentication. As such, look for ways to mitigate such risks through employee training, on-prem air-gapped backups, or even cybersecurity insurance. As Dora previously mentioned, many groups, especially private equities, are still looking at ESG as a key differentiator when selecting businesses to purchase. It may be the difference maker with buyers who are looking to choose from a couple of potential candidates. And finally, as the minimums for rep and warranty insurance continues to get smaller, more and more deals are starting to use them. It's often a good way to decrease any potential holdback from a buyer, which may net you more cash at close. Jenny, as our resident M&A attorney, are there any other risks in the M&A market to be on the lookout for?
Yeah, thank you. My name is Jenny, and I'm here to talk to the business owners and sellers who are attending today's presentation about select M&A legal term trends. And to level set for this portion of the presentation, I'd like us to congratulate ourselves and pretend that we're at the stage where we receive a letter of intent, in which case you're really there looking at the purchase price and the material terms. And I'm here to talk to you about select material term trends from the SRS Acquiem report. The first topic that we're going to cover today is with respect to indemnification. And I'd like us to think about this concept as an analogy. You know, when we buy cars, we actually get a warranty from the car dealership that covers the car from bumper to bumper for the first 10,000 miles. And if something breaks, what you do is you seek indemnification from the car dealership and they repair and make you whole. When you're a business owner and seller, you actually provide indemnification obligations for the benefit of the buyer. What the trend is leading to from 2022 to 2023 is that certain types of representations, which usually survive, right, have actually started to disappear. So in 2022, a lot of them actually didn't survive, and sellers were able to walk away with a peace of mind. That pendulum started swinging backwards in 2023. And what we're noticing per the SRS Acquiem report is that more and more sellers are going to stay on the hook for indemnification claims. Now, that's not to say that after you sell your business, you're responsible for an indefinite period of time. Per the lower graph on the right, what I'd like you folks to pay attention to is, I'll call it the second bundle within the 12-month period. What you'll notice on that is that the indemnification survival period after the sale, for which a buyer can bring a claim against the seller for you folks, is actually staying very steady at around the 12-month term. And so the idea here is for folks who are looking to sell, yes, you're going to be on the hook for operational risk that are typically pre-closing, but the typical period that it survives as of late, and what we see is it's holding around like a 12-month period. So we'd encourage you to ask more questions about your facts and circumstances after the presentation, so we can kind of tailor what these legal terms mean as to your enterprise. And the next slide, I'm going to talk about the concept of purchase price adjustments in the context of earnouts altogether. You know, I've been working as an M&A lawyer in excess of a decade, and oftentimes a lot of sellers, especially when they're, I'll call it within the sub 50 million enterprise value mark, oftentimes do not have their books and records prepared in accordance with GAAP. And what historically has trended is the buyer would force the seller to make certain types of statements like their books and records prepared in accordance with GAAP, quote, consistent with past practices. And it forces seller to make a statement that isn't entirely true because they were never consistent with GAAP to begin with. What we've noticed as a trend per the SRS Acquiem report is that the worksheet approach has been embraced a lot more as a way of reflecting, I would say, the true operations of the seller. So this is absolutely fascinating. If you look at the 2022 trend, you notice that around 54% said it was consistent with GAAP and past practices. I'll call it that classic approach. Versus in 2023, that actually decreased to 36%. And that worksheet approach is now a large, substantial amount of, quote, other. And so what we're finding is that a lot of buyers are really engaging sellers and really understanding, I would say, the enterprise and how sellers are truly operating their business. And there is a corresponding trend that is absolutely fascinating as well. And I think that when we look at the next slide with respect to earnouts, you kind of see this interplay between embracing the worksheet approach and earnouts. So before we talk about the topic of earnouts, I want to kind of look back 2 years. And for a lot of sellers, we see that while they've survived the pandemic, they haven't been able to truly monetize on the entire enterprise. What I've noticed a lot about my clients is that they have phenomenal businesses and they have phenomenal backlog. And as a result, while they feel that their company is worth significantly more, it has become exceptionally frustrating for them to exemplify and show buyers the actual profitability of their business. And so, as a reflection between, I'll call it the pent up demand and the backlog, one material term that has come to light is the use of earnouts. And this is a phenomenal trend where there's literally a 50% increased use of it from 2022 to 2023. And what the SRS acronym report is trending and showing that as a function of the purchase price, not only is, I'll call it past performance taken into a factor, but this backlog that sellers are trying to show that because they have a reputable business, they're able to earn the remaining amounts of the purchase price. So for a lot of folks out there who could be frustrated about not having buyers recognize their value, just know that there are a lot of legal tools as well with respect to earnouts that's trending for you.
Can I add there, Jenny? A lot of business owners, like you stated so eloquently, believe that their value is a lot more, right? So when you use the term earnout, and when an earnout becomes part of the component in an acquisition, you, the business owner, the seller, are committed to making sure you do everything in your power for that buyer to make those metrics, because that's how you're going to get paid. So thank you for bringing it up. I think it's a great point.
Right, thank you. And us on the legal side, oftentimes there's, I'll call it a bundle of legal terms where we try to shape and obligate, I'll say, a level of transition from the seller, because it's up to the seller's clients to really pay, but also a bundle of, I'll call it legal terms for the buyer to make sure that they actually perform, right? Because after the seller sells their business, they truly are no longer in the driver's seat. So for any sellers who see their business with significant backlog, feel free to ask us questions about what are causes and concerns that you have, especially if you feel like a significant amount of your enterprise value will be logged in with like an earnout. So within our next slide, I'd like to point out that much like, I'll call it a buyer taking more specific facts and circumstances together, likewise with risk allocation. So more specifically, oftentimes at a sale transaction, there's a percentage of holdback that's quote a general escrow. What we've seen as a trend in the SRS acronym report is not only is there this general escrow, there's also the use of quote special escrows as well to mitigate specific facts and circumstances. But what I'd like to point out is not only are special escrows on the rise, which is in addition to your basic ones, is that in the context of whether or not a transaction has representation and warranty insurance, that's when there's actually a larger use. So on the bar chart on the far left, you'll notice that all transactions actually had at least one or more escrows. The next one in the next bar chart going from left to right, there are two or more. And what I'd like to show you is that if you look at the teal box in the middle, where there's no rep and warranty insurance identified, it's around 49%. And if there's rep and warranty insurance identified, then it's a higher percentage of 74%. So I think it's actually a little bit more insightful, because when you look at the use of the escrow, oftentimes not only is there the use, but the amount also has an impact, right? So we could move on to the next slide. If we could move on to the next slide. Yep, thank you. Oh, sorry, back one. Great. In one sense, I always say, like many things in life, size matters. And so if you look at the escrows without rep and warranty insurance, the average size of them, and if you look at the middle where it says 30, 39, and 29%, the average size is hovering around 5 to 10% on the top chart. But if there was rep and warranty insurance in the transaction, what you'll notice is that all of a sudden, a large majority of escrow holdbacks are less than 0.5% on the far left. And so this is a stark circumstantial change in whether the transaction includes insurance. So I think this is actually going to be a really great transition now for Dora to talk about the representation and warranty trends, the use of it. And Dora, take it from here.
Yeah, thank you, Jenny. I think you covered it. So what is reps and warranties insurance? It's a special insurance policy that's designed to cover losses resulting from breaches of representation or warranties. So when you're selling a business, you will provide to a buyer a disclosure schedule. And basically you're disclosing anything and everything that you know could go wrong with your business or has gone wrong with your business that could potentially come back and haunt that new buyer. But you are not expected to remember every single detail. And that's why you work with someone like Jenny or Jeff that walk you through that process to make sure you address anything that creates risk post-closing. So buyers in making an acquisition to reduce the escrow amount, and all that is part of the negotiations, will require reps and warranties insurance so that they feel that there's a comfort level that if something comes up, that there is a policy that they can draw from to make themselves whole. So as Jenny covered, is the average escrow amount is reduced from 12.3% to 2.3%. And that's significant, right? So if you were post-closing, leaving in an escrow account $2 million, imagine that being reduced dramatically. So when are these policies used? Frequently in deals that are valued at above $50 million. But what we're seeing as a new trend is that there are insurance companies, players that are coming into the market and insuring deals below the $50 million. So that has also helped fuel deal outflow. If we go on to the next slide, we look at who benefits from having reps and warranties. It's not just the buyer, but also the seller. Just that peace of mind that if something happens, that there's that insurance policy that's covering that. Who pays for this? So it's usually negotiated between buyer and seller, but we see it, we've seen it both ways, where the buyer will pay for it, or where the seller will pay for it, or will they mutually will pay for it. The typical terms of these policies limits 10% of the company value, and the premium is about 2 to 4% of the limits. And the retention of 1 to 3% of company value, and the exclusions are common. Of course, if you know there is a breach, they're not going to cover it. If there is employee payroll and retirement account issues, those are not going to be covered. So it's really important that you as a business owner pay attention to the areas that make you responsible post-closing, so that those are properly disclosed in a disclosure schedule and they wouldn't therefore be an excluded item. So we're seeing that the trends, as Jenny has explained, 75% of all private equity deals are using reps and warranties, and strategic acquirers are also using reps and warranties. Prior to 23, the typical policy size was for deals greater than $50 million, but now we're starting to see $10 to $20 million in deal size. And as we go to the next slide, we look at some of the outlooks and trends and themes, and I'll turn that over to Chris.
Thank you so much, Dora. So here are some projected trends in store for the M&A market next year. With the new administration taking over early next year, the market is projected to be optimistic but cautious at the start of 2025. What Plethora has heard from multiple private equity groups is that they will be looking at the 100-day plan from the Trump administration to help guide their plans for 2025. As such, M&A activity will depend on executive confidence and available cash reserves. Buyers are going to continue to expend significant energy in negotiation and diligence, regardless of interest rate movement next year. This might mean offers falling short of seller expectations, along with more structured deals. AI, while still a burgeoning product, will continue to develop and act as a disruptor in the marketplace across all sectors. As discussed in a previous slide, strategic buyers will continue to take a lion's share of the deals in 2025, but financial buyers will look to rebound with large amounts of deployable dry powder. It's a case of use it or lose it. Private equity groups don't make any money unless they deploy their dry powder. Finally, data analytics will continue to play an important part in the M&A process as buyers' appetite for more data continues to grow alongside their system's ability to quickly onboard and integrate new acquisitions. This will come into play especially during diligence and quality of earnings, where the buyer is looking to comb through all available data to prove out the valuation. Let's now move on to some additional trends that we're projected to see next year. So here's some general market trends. So for generational shifts, we're seeing a lot of the baby boomers who are starting to age out and will now be looking to sell their business, thus creating a buyer's market. Dora, did you have any additional? Okay. And then obviously sector specific opportunities. If you look to the right, you'll see top trending sectors, which goes into more detail on slide six. Next year, we'll be looking to see similar trends as well, B2B, B2C, and IT tech being the top three. So those will be the main targets. And then secondary buyouts. This is when a private equity firm sells its stake in a company to another PE firm or to a strategic buyer through a public offering or some other form of exit strategy. Because next year will be a bullish market, we're going to see more deals as a SBO. And then I will turn it over to Dora, who will be going over M&A outlook.
Okay, so we covered a lot of information, and all of it kind of boils down to one thing. What makes a company attractive for acquisition? I mean, there's a lot of anticipation that 2025 deal flow is going to grow. You've got strategic acquirers with appetite for acquisitions. You've got private equity group with nearly $3 trillion that they have to deploy or lose it. So how do you, as a business owner, look at what makes your company attractive? Is your supply chain resilient? Have you considered what will happen if there's another pandemic? And if the logistic channels close down? So we're talking about nearshoring. Christopher covered that. Local sourcing and multiple sourcing, not just relying on one vendor. Working closely with your vendors so that they can anticipate your deal flow, your pipelines. Are you a tech-enabled business? Have you implemented technology efficiently? Are you taking advantage of some of the new AI products out there that will create efficiencies in your business. Another one, recurring revenue. A lot of private equity groups, when they're looking to make acquisitions, the first criteria that they ask us about is, what is the recurring revenue? This is something that can help them project the income of the business so that they can make their investors whole. Do they have an above average margin profile? So if you're a business that is running profit margins of 10%, you're not going to be as attractive as a business that's running a profit margin of 20% or 30%. So as the CEO, what can you do in your business to grow those profit margins? Do you have a strong management team in place? Is the business dependent on you? Can you take a vacation and totally unplug from your business? Because guess what? We cannot sell you the CEO. A private equity group or a strategic acquirer is looking to purchase a business that can run without you, the founder, or you, the CEO. Do you have a conservative approach to market expansion? Are you making projections? Are you planning forward? Or are you simply just showing up? If you're showing up, I think it's time for you to reconsider your role in the company. If we go to the next slide, I think the actionable takeaways for you as CEOs is focus on de-risking your operation. Diversify your customers and suppliers. If you're a business that runs customer concentration greater than 25%, you're not going to be as attractive to an acquirer. Do you have a key person dependency? What happens if your top salesperson gets recruited to another firm? How will that impact your organization? And these are important questions for you to take stock and really sit down and think about, especially if you're in the process of considering an exit. Financials matter. We covered this, Jenny covered this on that rep and warranty and those representations where according to GAAP. Well, I cannot tell you how many financials we look at that are not according to GAAP. And we're talking to business owners, 4 or 5 business owners a week consistently. And one of the biggest pieces of advice we give them is get with your CPA. Develop a plan to have your financials reviewed. Invest that money now because it will yield benefits. That buyer that is looking to acquire you, if your financials have been reviewed, has a better reassurance that you will get through the quality of earnings and diligence. So prepare yourself, focus on growing your profit margins. This gives confidence to a buyer coming in. And most importantly, it will also increase the value of your business. And lastly, think about your management team. Whether it's a private equity group or a strategic acquirer, they want to see that business continuity. And you can do that by having a strong management team. Next. So I'll turn the floor over to Jeff for effective tax planning and preparation for an M&A transaction.
Thank you, Dora. Now that we've learned about some of the outlook for 2025, we'll take a look at the tax side of the transaction. So the first item we're going to look at is, planning for how the sale would be taxed. We have 2 buckets of income that we always work with. First one being ordinary income, the second being capital gains income. And so capital gains comes at a preferred tax rate. It's a lower tax rate than ordinary income. So if the sale or a part of the sale is taxed at capital gain rates, uh, that can be 23.8%. And the maximum capital gain rate is 23.8%. Compared to an ordinary income tax rate, maximum rate of 37%. So you need to think about or know that some of this portion of the gains are going to be taxed at 23.8%. Some might be taxed at 37%. So um, you need to keep it in the back of your mind as you work through the sale. So why is it one or the other? It depends if you're selling um, the assets of the company or the stock or partnership interest. So sellers prefer to sell the stock or the partnership interest because that is taxed at capital gain rates. Buyers typically want to buy the assets of the company because the sale price allocated to that, the fixed assets, um, can be depreciated. So the buyer would be able to recover some of their cost of buying your company through depreciation. So we have to consider, these ordinary, well, how it's going to be taxed, ordinary or capital gains, and then also restructuring options as it's related to the sale. So on the next slide, we're going to look at structuring options, how they might differ based on your entity type. So restructuring an entity before or as part of the sale transaction can be crucial to closing a deal that satisfies both the seller and the buyer. You might be currently organized as a partnership or an LLC. You might be a corporation, a C or a S. And so, depending on how you're currently structured, the options for this sale would vary, right? We would have different set of options depending on what type of entity you currently are. And we also might have an option to restructure or change the entity type if that's not what the buyer needs to close the deal. So your advisors will look to see how the business is currently structured and see what options are available to make the sale more attractive to buyers. If restructuring is needed as part of the sale, often we'll perform what's called a tax gross up option, which means we determine based on your entity type, we'll determine the tax cost of the sale, and that might be added to the sale price to cover your tax obligations as part of the sale. The buyer would go along with that if they're able to recover that cost through the depreciation. So they might be able to offset and be willing to accept that as part of the negotiation if they can recover the costs associated with that through depreciation. So that might be part of it, restructuring. Let's go on to the next slide. Yeah, the purchase price allocation. As I mentioned, you're going to be offered a price, and we need to allocate that price between the various assets of your business. So, the buyer, as I mentioned, they might prefer, not only would they prefer to buy the fixed assets, they would prefer to buy or allocate most of the sale price to assets that would yield the highest depreciation. The seller, on the other hand, would prefer to, again, as I said earlier, allocate everything to maybe goodwill or just to have a stock sale or partnership interest sale, because that would be taxed at capital gain rates. So since you have this opposing goal, there is a form that has to be completed, a 8594. asset acquisition statement, which is filed on the seller's tax return as well as the buyer's tax return. And that discloses to the government how the sale price was allocated. So it has to be the same because, again, you do have this opposing position where the buyer would want it allocated one way, the seller would want it allocated another way. So you do have that statement to file. And this is all part of the negotiation when you get into um, the, uh, the sale. It's part of the negotiation is how not only at the total sale price, but how that sale price is broken up um, to the various assets of the company. Along with that, we'll have tax projections, numerous tax projections, but before the closing, at the closing, after the closing. We go through that because you want to determine, you'll want to know what is left after the sale. Very often, sellers will get that incentivized by that big offer amount that they just received, right? They that's what their eyes are on, and they forget to consider, you don't get 100% of that. Maybe half of it might go to taxes. So we do have to run these projections so net cash after the sale. Does it make sense for your planning, your retirement, maybe charitable gifting goals? The tax planning not only helps to minimize taxes, but it does also help to build the plan for yourself after the sale. So you'll want to make sure that you'll work with M&A firms, tax attorneys to make sure that the deal goes as planned. Let's go on to the next slide. The fees for the overall transaction, they can vary. As we talked through today, there's a lot of items to consider. So you certainly will need to hire CPAs, attorneys, and a business broker like Plethora. And all these consultants bring in expertise that's critical to getting the deal accomplished that you want. And certainly it comes at a cost, but when you consider, things like real estate that you'll pay 4 to 6% on commission, the transaction cost for the advisors, is really a fraction of that. In some cases, it could be less than 2%. So consider that again as part of the tax planning or walking through the deal. Not only will it cost you in taxes, you will have to set aside some money for the um, advisors that you are using, but it's well worth it to get the end result or get the expected end result after the deal closes. Let's go ahead and go on to the next slide. We're going to spend a minute on new tax law. So we haven't really had any tax law that's directly affected M&A activity. We've had two recent tax bills in the last few years, the Infrastructure Investment and Jobs Act and the Inflation Reduction Act. We don't have anything in front of us right now because, of course, we're waiting for the new administration to take over, and then we can see what their plans are. I'm going to hit on their plans in a couple of slides, in a few slides. But for now, we do need to at least consider or kind of go over what was talked about before, because it might come up again in new tax law. So let's go ahead and go to the next slide. And in the Inflation Reduction Act, one item that came up in that is the qualified small business stock. For a while, that was either not taxable or had reduced tax associated with it. And that part of the law was under um, they were looking to change that part of law or take that away. But that did remain unchanged under the Inflation Reduction Act. So we still have that as an option to help defer or reduce some of the gains that you'll incur as part of the sale. Also in the Inflation Reduction Act, we have the SALT limitation. You may or may not be familiar with it. You probably are. I'm sure your accountants have talked to you about it. But currently, right now, our state taxes that we used to deduct on the federal side of the return are limited to $10,000. And so, certainly, when you sell the business, you're going to pay a lot in taxes, also a lot in state taxes. And you used to be able to deduct that on your federal return. Right now, we're capped at a $10,000 amount for all income, property tax, all any type of tax. So, that is a limitation that we're working with right now. They've been looking to change it, and they were looking to change it in the Inflation Reduction Act, but it was not changed. Let's go ahead and look at the next slide because we do have AB 150 that can help offset that limitation of the SALT. Um, and this was signed a number of years ago. We're coming into the end of it, 2025, if there's no other change to this limitation. And we don't know, what's going to happen with it with Trump. But if nothing happens, it's going to expire at the end of 2025 because the Tax Cut and Jobs Act will expire at that point. But AB 150 will allow you to deduct through the business 9.3% of that share of income. And that includes when you sell the business. So that taxable gain that you'll have, the business can deduct 9.3% of it. And therefore, when it flows into your individual return, you'll save taxes at the federal level because now instead of deducting only $10,000, you can actually deduct from the federal income from the business the full amount or 9.3% of the state taxes on the sale. A couple of other ideas out there. We've had qualified opportunity zones. These were established also as part of the Tax Cut and Jobs Act. They may stay, they may not stay, but that might be an option. It was a tool that was available the past few years that would allow you to park or contribute the gain, really from anything, but a gain like a business sale, into these qualified opportunity zones and either exclude the gain, which is that option is gone now, but you can at least defer it still. If you think in 2 years, maybe you'll have another transaction that might offset it. Often we'll look at when we sell a business and when you have a large taxable gain, you can't do anything to change that, but you might have other transactions in the future that can help offset the gain that you have on the sale of your business. So if this year you can't do anything with the gain on the sale of your business, maybe you have another transaction in the near future that if you deferred the gain a couple of years, you could offset it. It just depends. Sometimes you can't modify the gain on one item, but you have other items that might be able to reduce it if they fell into the same year. So Trump's tax plan, what we can maybe look at as we move through 2025, that is, the SALT limitation. If it goes away or if it stays, hopefully it will go away. But that would be a item. 100% bonus depreciation. He's looking to bring that back. R&D expensing, we've had that as a huge issue the last couple of years. Not being able to deduct all the expenses that were related to R&D. So if we do get that to come back, then again, that would be a benefit for for income taxes and certainly from the business that flows into your personal return. Reduction of the corporate income tax rate from 21 to 15% is another item that he's been looking at. And we had a couple more on the last slide here. The deductions for interest on auto loans on U.S. made vehicles, that's been floated out there. Certainly, he's looking at increasing and would like to increase child tax credits and credits for family caregivers. And he's looking to keep the capital gain rates the same, so unchanged. We mentioned the items under Trump, so you could again maybe use those as tools to help offset the gain from your sale of your business, or to realize when these items are discussed, it may come at the expense of one of the other items. Child tax credits might come at the expense of a cap on the state tax deductions, the SALT limit. We don't really know, but it is helpful to at least let you be aware of what's going to be talked about in 2025, and um, we'll see how it plays out.
Awesome. Thank you so much, Jeff. So now we're going to get into some questions. We do have questions for kind of everyone on the panel right now. It is, if you are trying to get ready for sale, when should you start?
Jeff, I'd like to tackle that one. I think in touching the issue of taxation, we cannot reemphasize to those business owners that are contemplating a sale the importance of working with your tax attorney, with your tax CPA to tax affect your transaction and give you the opportunity to plan ahead, implementing strategies to mitigate that tax. If you do it correctly, it could be the difference of saving millions of dollars at the time of sale. So for us, we encourage 2 to 3 years. It's the proper amount of time that it's needed to be optimal for a sale.
Great. Maybe I'll go next in this one. You know, when we look at legal issues combined with tax issues, the common phrase that we use to measure time is, what is the statute of limitations for which a claim can be brought? Like, right? And so without looking at every single claim, we oftentimes use a broad heuristic of 4 years. And the overall concept is, if there is a risk that a seller is worried about and they want to be in the driver's seat in managing that risk, oftentimes talking about that issue proactively from when they discovered a potential issue in 4 years and dealing with that is a healthy way of knowing what they can do to kind of mitigate anything while they're still owners and drivers like of the business. Jeff, what are your thoughts?
You know, my thoughts are, and also in my own experience, sometimes a lot of these deals, the offers to buy your company come when you're not selling it. And what I mean by this, somebody out of the blue will show up and say, you know what, I like your company, I want to buy it, I want to buy it today. And so while it takes 2 or 3 years to fully implement some of these ideas that we've gone over to today, you don't always have that time. And so if you're edging towards retirement, that you're edging towards a point in time where you might that you might need to sell or want to sell to start your retirement. You need to start thinking about this now, so you can kind of work through some of these decisions when you're not under the pressure of a offer that you have to make a decision on this week. Sometimes that's what happens. You'll get an offer and the buyer would want to buy it fairly quickly. And so you need to consider all this and actually it'd be nice to have a plan in place that you could pull off the shelf and implement should that offer show up, next week. You never know when it comes.
And start preparing your business ahead of a sale. Think about the end result. Where do you want to be 5 years from now? And if it's in retirement, then start making those implementations now. Due diligence process is it's tough. Not every deal makes it through a due diligence process. And so the more proactive you are about your business, about these ideas of what will I encounter in due diligence, working with Jenny, working with Jeff, working with the likes of your financial planner, the more equipped you will be to be able to take advantage of those opportunities when they do come.
Awesome. Well, thank you everyone for joining us so much. If you guys have any other questions, feel free to reach out to our presenters. Just as a reminder, you guys will be receiving a copy of these slides, the contact information for all of our presenters, as well as a recording link to this presentation. Just look out for it in your email later today. But again, thank you, Jenny, Jeff, Dora, and Chris. This was such a great presentation.
My
Thank
pleasure.
you, Tammy.
Thanks again for joining us and have a great day, everyone, and we'll see you next time. Bye-bye.